Hi, good evening, everyone. Thanks so much for joining tonight's Corporate Connect. My name is Gerald, and I'm very pleased to be your host for this evening. For today's Corporate Connect, we have with us Resources Global Development, as well as our audience from Moomoo Live. This Corporate Connect is organized by SIAS and supported by the SGX Group. So what we will do today is we will kick off today's webinar with a presentation by Mr. Isaac Lim, who is market strategist at Moomoo Singapore. He will share with us some of the key market highlights. Thereafter, we will have a corporate presentation from Mr. Francis Lee, who is the CEO of Resources Global Development, as well as Mr. Thomas Yeo, who is the CFO of Resources Global Development. So without further ado, we'll kick off tonight's session by having Mr. Isaac Lim provide us with a market update.
Hi, thanks everyone. Thanks Gerald for that very kind introduction. So let me just make sure that I'm sharing my correct screen. Right, so thanks everyone for your time this evening. Right, so my name is Isaac. I'm currently the Chief Market Strategist over here at Moomoo. And without taking up too much time, let's dive right into it. And since this is the start of a new quarter, right, we are now into Q2 2024, I thought it's very timely to actually share what I see that we as investors are approaching, what we can expect to see for this quarter, right? This quarter, and what I think where I think the investment opportunities lie. So very quickly, I'll just share what has happened in the Q1, right? And then after I'll dive right into Q2. And then of course, if you guys have any questions, feel free to reach out. I'll do my best to answer. Right, so very quickly, we start off with the summary, right? So what has actually happened in Q1 is that inflation has been and will continue to be sticky, right? As you guys already know, you guys are in the markets, right? We have seen inflation, CPI, PPI data been really quite sticky. US economy is quite robust at the start, right at the start of the year, right? S&P rallied straight out the gates, right? Initially, analysts were expecting the US Federal Reserve to start pivoting and cutting rates in March. And then that has sort of been pushed back to June. And now that we're in Q2, even whether the Fed starts cutting rates in June is now being questioned. So in Q1, economic data and the stock markets do not add up, right? So we have a very robust job market, right? Inflation numbers are high, but we're still seeing people continuously be employed in the US side, right? And even in Singapore, you know, our manpower minister has actually made it clear that our employment, right, is at a very nice level right now. So for Q1, I actually shared with the clients that, you know, there's a possibility of a regime change. And what that means is that, you know, we are moving from a negative correlation between yield, interest rates and equities to something that is a positive correlation. I will show the charts to you guys shortly. And essentially what this means is that we are seeing higher for longer, right? Elevated interest rates, and at the same time, equities ideally should continue to climb higher. Now in Q1, I was actually calling for a nice healthy retracement of about 3 to 4%. That has not happened. In Q1, the S&P has actually continued to rally and make new highs, right? STI has been holding its territory very well, consolidating very nicely, right? However, with the overextension of the S&P in Q1, what this then means for Q2 is that the downside risk is now anywhere from 8 to 10%, right? Imagine with me, if you will, is like a rubber band, okay? If you stretch a rubber band a bit, right, the snapback is not going to be that painful. But if you're going to stretch the rubber band for even longer and even further, then the snapback will start to hurt, right? So that essentially means that, you know, the risk here for the S&P is an 8 to 10% pullback. Right, so very quickly, I'm just going to show you guys, this is the negative and positive correlation chart that I've been talking about, but take note, it is a very long-term correlation chart. So about 1950 to 1980, late 1980s, right, we see positive correlation. Orange line is the US 10-year yield, which represents the interest rates, right? And of course, the black line is the S&P. Right, so you can see that interest rates from 1950 to the late 80s, interest rates have actually been appreciating, and the value of the S&P has also been climbing higher. But it's only at the turn when we entered the 1990s and all the way up to as recent as 2022, right, we see a negative correlation. So those my age, right, as we go through business and economic school modules during university, we have been taught that the theory is that yield and equity prices are negatively correlated. But if you were to extend that viewing glass much further back into the past, you realize that this is not entirely true. Market cross-asset correlations tend to swing from positive to negative. And where we are now, right, interestingly, we are starting to see, S&P climb higher. The US Fed kick-started the ball rolling, trying to control inflation by raising rates. But end of the day, we're starting to see that rates are higher, S&P is higher, even the correlation coefficient is going into a positive territory. So what this really means, as I mentioned, is really we are looking at the start of a new regime change. So that really sums up the Q1, right? I really want to move on to Q2 2024 outlook. Now, I have highlighted 3 themes here for Q2. First point is that we are seeing the new macro, sticky inflation, structurally higher rates, and resilient growth. So that I've already just covered in the previous slides. Now, I think what is more interesting, especially in line with Mr. Francis and what they're going to share, right, is really commodities. Commodities has been on a tear, right? And I think commodities is the bull in the China shop that we should all really be looking out for. And it's still, in my opinion, not too late to get into the commodities run. Right, and now, of course, the third macro theme for Q2 will be the US presidential marathon. Now, this may be far away from us since we're here in Singapore, right? But what the US does, their president, right, and the policies that he employs, right, will have far-reaching implications across the globe, right? So why I say it's a presidential marathon is because generally speaking, the candidates are decided sometime in June and end of June. But this time around, it seems that the entire Republican Party has thrown their support behind ex-President Donald Trump against the current incumbent President Biden. So the presidential race, instead of starting in June, has already generally started much earlier with all the mudslinging and the politics, right? So it's going to be a longer lead up into the November elections. So more of a marathon, not so much of a race. Interestingly, it's also the first election rematch in 50 years. So what are some of the interesting things to look at? From the equity side, right, I'm not going to spend too much time on this because I have limited time, right? But from the equity side, okay, I very much prefer the Nikkei against the US equity index, the barometer, which is the S&P, right? Reason being, there are a couple of factors. The first factor is that the US stock market, right, we're starting to see a bit of an over-concentration risk, right? A lot of the US stock markets, the mega caps are more focused on tech, more focused on the semicon, right? And all the AI plays. So there's a serious over concentration risk over there, right? And that's the first factor. Now the second factor is the market volatility. So if you look at this chart, the blue line is the S&P, the white line is the Nikkei, right? So I'm just going to do a little bit of drawing here, right? So bear with me. But if you were to look, right, at how the S&P reacts, okay, especially from 2021 to the middle of 2023, you can see that, of course, while the S&P was rallying higher, okay, the Nikkei was generally in a sideways motion. And then after that, when at the start of 2022, when the S&P erased almost all of its gains, the Nikkei was still holding its base very well, still consolidating sideways. So whether the S&P, at least for the last couple of years, whether the S&P goes up or down, right, the Nikkei has held its value generally well. Now, in more recent times in 2023, you can see that towards the end of 2023, when the US Federal Reserve started hiking rates, right, the S&P actually did quite a volatile push lower, But what happened to Nikkei was that Nikkei was once again holding its base very well. It was only when we entered into 2024 and we see the S&P rally higher on the AI bandwagon. And of course, Nikkei has also sort of played catch up, right? In terms of the index performance, right? So you can see that when the S&P is facing serious downside volatility, the Nikkei tends to hold itself pretty well. And of course, when the S&P rallies, right, we can see that the Nikkei rallies along with it with quite strong positive correlation as well. So from an equities point of view, what we really prefer, right, at Moomoo over here is that for now, we prefer the Nikkei against the US stocks, right? So it's always good to diversify a bit, and very nicely, right, Moomoo, we will also start to have access to Japanese stocks. All right, so moving forward, okay, let me just continue. Okay, so this is the Nikkei against the S&P. I'm not going to waste too much time, right? Let me just clear all drawings. I'm not going to waste too much time on this chart. I really just want to move on forward, right, to something that is interesting, right? When we touch on FX and fixed income, right, here is the US yield curve, okay? And the yield curve is still currently inverted. What this means is that people prefer the market investors prefer the short end of the curve, right? So they are looking at the 2-year interest rates, right? The shorter term interest rates compared to the longer term interest rates, right? So they have more confidence, right, in the near term as compared to the longer term picture of the US markets. So if you're to look back at the US yield curve, the 2-10 spread or the 10-2 spreads, depending on how you want to call it, but basically a market recession, a crash really only comes when the yield curve has inverted, gone below the zero line and come back up above the zero, right? So, I mean, of course, over here it shows 2013. I cannot put on the chart and on the slide here all the way back to 2008 and even the .com 2000. But you guys can go and look at the chart, right? Every time there's a market crash, it's only when, according to the yield curve, right, we invert below zero and then we come back up above it again, right? So right now, at least for the near term, this quarter, right, as long as the yield curve stays inverted below zero and doesn't cross above zero, right, we can expect equities to continue to rally. And on the Moomoo side, we prefer the short end treasuries as compared to the longer term treasuries. All right, so that's for the fixed income side of things. I'm not going to cover USD because I think there's going to be a lot of volatility coming up for Forex because of the US presidential election and also the interest rate story that the US Federal Reserve may or may not pivot in June, right? Or it may be pushed back. Is it still going to be 3 rate cuts or is it going to be less than, 3 rate cuts? And then, of course, I think one very important thing to highlight, right, going into Q2 is commodities, right? So a lot of people have actually been focusing on commodities as a whole. And I think rightly they should, right? If you were to look at, if all of us were to look at commodities, just give me a moment, right? If all of us were to look at commodities, this is the Bloomberg Commodity Index, right? You can see that the Bloomberg Commodity Index, from a technical perspective, we have actually already broken above this descending trend line, resistance turn support, right? And for those of you who are actually who actually believe in looking at Elliott wave, right, then you'll see that if this is a wave 3 down, right, taking a retracement from this point to the low here, we would have already crossed above the 23.6% retracement level. Now, for Elliott wave practitioners, in the event of an impulsive wave, when we break the 23.6% level, what it means is that we would ideally see a push all the way up to the 61.8% retracement level. Now, of course, 61.8% retracement is quite far away, so I've identified a nearer term resistance level around the 108 level, and that is also in line with the recent graphical swing high resistance. So what this chart is trying to tell you, long story short, is that Bloomberg created this commodity index, right, that takes into account all the basket of commodities. So you have gold, you have silver, you have coal, you have coca, right? orange juice, everything is inside here. And the story here that the index is trying to tell you is that commodities is starting to see a nice rally, and we are in fact not too late to the party, so to say. All right, so that is really the Bloomberg Commodity Index. Now, of course, I personally have my own pick, right, when it comes to the commodity index, right? This is just a very quick chart, comparing between gold and silver. But one interesting thing that I would like to share with you guys is the blue line represents silver, the white line represents gold. Now, look at the spread, right, between silver and gold. Whenever the spread between silver and gold, right, is so wide, silver tends to play a catch-up to gold, right? The spread gets narrower and narrower. And finally, when silver outperforms gold, it pushes above gold, you can see that it stays above gold for quite an extended period, at least a year, right? Same thing when silver underperforms against gold, right? It stays below gold for about a couple of months as well. Now, what has happened in the recent months is that we know in the news that gold has been making all-time high, right? Historical high. And you can see that the spread between gold and silver is also quite wide. But of course, silver is now trying to play catch up with gold. And you can see the spread widening once more. So for those investors, those traders who actually think that, gold is a bit too expensive to get into now, right? My choice to get into the metal rally would actually to be using silver as a proxy. All right, so that really is the long story short of what we see over here at Moomoo in terms of the Q2 market outlook. All right, and just to sum it all up for you guys, okay, the key calls that we have, the trade ideas that we like is first and foremost from the equities point of view, we still favor US and Japan equities, right? But of course, between US and Japan, we definitely prefer the Japanese equities because of lesser concentration risk and lesser comparative volatility. And then, of course, moving over to commodities, while gold is still a good focus, silver has yet to play catch up. And from the Bloomberg Commodity Index, right, you can see that broad base across the board, right, there is still quite a bit of room for commodities to rally. Now, of course, this can be due to supply shock. This can be due to geopolitics, right? We have also seen that oil has finally crossed the $90, 90 US dollars per barrel price just very recently. Okay, and so that's for commodities. Going over to fixed income, right? As shown to you guys earlier, the US yield curve, the 10-2 spreads, right? We definitely favor short-term bonds now, at least for this quarter, as inflation and interest rate remains elevated, right? And the yield curve still remains inverted for now. All right, so that really sums up the outlook that we have over here at Moomoo for Q2 2024. Now, I have a couple of minutes for questions, but otherwise, you can always drop me an email, right? My email is isaaclim@sg.moomoo.com. That again, isaaclim@sg.moomoo.com. All right, thanks everyone for your time, and Gerald, over to you.
Thanks so much, Isaac, for the market update. And I think that provides a very good introduction into what to look out for in the second quarter. I think one of the sectors you mentioned is really the commodities industry. And I think that makes it interesting for why we are having this conversation with Resources Global Development tonight. For those who might not be familiar with the company, Resources Global Development was listed on the Catalyst board of the SGX in January 2020. The company is the provider of trading and shipping services in Indonesia and specializing in thermal coal procurement from mines in South Kalimantan. The company also provides chartering and transshipment services within Indonesian territory for commodity traders. So with that, I would like to invite the management of Resources Global Development to share with us some of their key business updates. Francis, can we get you to unmute yourself?
Oh, okay. Sorry.
Thank you.
Okay, well, can you hear me now?
Yes, we can hear you clearly.
Yeah, okay. All right. Yeah, thank you very much for having us on board. Thank you for taking time, especially this precious after our time to connect with us. My name is Francis, and I'm the CEO of Resources Global Development. Henceforth, I'll be using the short term RGD. I think Gerald has give a snapshot of RGD. But let me just try my best to explain within this short 20 minutes of what we do. Starting with this slide, previous one. Yep. Okay. What you see here is a tugboat right at the front, pulling a what we call a barge. Right at the back, the black color floating barge that carries about 8,000 plus ton of cargo. Just to have a visual appreciation of that. Yeah. RGD is essentially having two segments of business, trading as well as shipping. Now, I think for most people, when I talk about trading, I think it's not difficult to understand. Our main product is really thermal coal. As what Gerald has said, we source our thermal coal from Kalimantan, and we sell them off to our customer. So that's one of our income pillar. The other segment that is essential for us is our shipping services. We essentially is in the logistics of moving resources around between islands, from the jetty to the mother vessels, as well as to the end user. So really, this is the two income pillar for RGD, a very simple brick and mortar business. Okay, move on. Yeah. Now, I think in the investment world, of course, the number speaks for all. So let's look at what we have achieved in the last financial year, 2023. We moved on. Move on to the financials. Yep. Okay. So I just want to highlight to you, run through the key highlights in point form of what we did in FY 2023. Starting with our shipping revenue itself increased almost 50%, which I will later explain as to what's behind the numbers. Of course, the driver of it is the continued fleet expansion. On the flip side, our trading business has taken a hit. Volume has been down, and it's impacted mainly because of the lack of coal supply. Now, again, this part of it, I will also address later part of the presentation as to what happened and what are we going to do about it. And on the overall, our gross margin has improved by 10%. We have a strong, given our model, the two segments, we have a strong cash generation ability, mainly from our short cash cycle of our shipping and trading. We also have a very low debt to equity, as you can see, you know, from the financials and our balance sheet. We have also declared a dividend payout of 3.5 cents per share to end the financial year 2023. And what's more interesting would be, which we have announced going forward, is that we will diversify into coal mining, which is to address our trading segment performance. So for FY 2022, let's look at the numbers that we have achieved. If I can draw your attention to the bottom two squares, where the shipping revenue has actually increased by 46%, and negated by the trading revenue down by almost 64%. And as a result, the combined total revenue is down 41%, right? From 180 million in FY 2022 to around about 106 million in FY 2023. Now, what's interesting is that if you look at the segmental revenue breakdown, you can see that on the overall, the shipping has really crept up and grown and has taken a substantial 51% of the total revenue mix. Next, please. Okay, next, again, the same picture is being conveyed. If you look at our GPs, shipping GPs have gone up by about 53%. And then again, is negated by our trading GP down by almost 83%, giving a total GP of something like 12% below FY 2022. Now, again, if I can draw your attention to the bottom right-hand corner where we look at the GP margin, then you can appreciate how profitable our shipping margin is. For the last 2 years has been above 50%, yeah, compared to the trading. So with the growth in our shipping segment, has resulted in the overall GP margin for the company slightly above 30% compared to a previous year of 20%. Okay, coming to the profit figure, the same story that goes through right from the front. Our profit before tax took a tumble of almost 15%. And again, that is a lot got to do with the fact that our volume in trading has decreased, but is cushioned by our growth in our shipping. So we ended up the year with a net profit of 27.1 million, down by 8.5% compared to last year. Okay, now this slide actually, I mean, for those who are interested in the numbers, as you can see, presents basically showing our ability to generate cash. By the end of the financial year, we are sitting on 27 million cash in our bank. And then what is interesting is that if you look at the top line, where operating cash flow is, we were able to generate, almost 35 million before working capital. And the line before, after that, which is the net cash generated from operating activities, that's almost 47 million. Okay, no, that's okay. If I were to look at the numbers in the longer horizon, taking into 4 years, you can see a typical trend, which is from the time we were listed, we've been growing for the next 3 years, 2020, 2021, 2022, and it's a common trend right across revenue to gross profit to net profit to profit attributable to equity and so on. The only year that has dipped is really the last year of FY 2023, and there's a reason for that. And the main reason for that is really the drop in the volume of trading, which again I said I will address it in the later part of the presentation. So we are, as you can see from here, once you do a time comparison over the 4 years, that other than the FY 2023, we are actually on a pretty aggressive growth path that we have experienced. Okay, as I have previously said, with the 2 engines that we have, let me just highlight to you our shipping side where we have managed to grow it. As you can see from the pie charts from FY 2020, where shipping was merely a 46% in terms of gross profit, ending 4 years later in FY 2023, occupying almost 91% of the overall gross profit. Next, please. Now, this slide shows the reason behind the numbers. Okay, Since IPO, we have grown from 9 vessels to currently 24 vessels, making up of 23 tugs and barges and 1 bulk carrier, as shown below. Now, what's interesting to highlight is that this year alone, in 2024, we'll be looking at about 9 sets of tugs and barge to be added on. At the bottom, you can see that it states 7 more sets of tugs and barges because 2 sets have already been delivered. One was in January and another in March. Now, what does that mean? Essentially, we are looking at something close to 300,000 deadweight ton by the end of 2024, as compared to 236,000 deadweight ton as of now. Now, that's a substantial shipping capacity that we are adding on, and that will contribute to the performance of the company. So as far as the shipping segment is concerned, I think we have been able to execute according to our fleet expansion plan, and that has resulted in the good performance of our shipping segment. Now, okay, let me address the trading side of things now. I think the lackluster, what has pulled us down in FY 2023 is really the volume of our trading. We were unable to secure a good volume for us to trade as far as the coal is concerned, and as a result, we see a decreased performance from that. So what we have done going forward is that over the few years that we have been working on, we were finally able to get our hands into acquiring the coal mines ourselves. Prior to this, RGD has always been trading. In other words, we buy from mines and then we sell to our customers. But as of January of this year, we have been able to acquire up to now 5 mines that would give us a total coal reserve of 226 million tons. Now, what does this mean? This actually gives us the security of supply for our trading segment, and that itself will become an engine of growth, or second engine of growth for RGD going forward. So for the next couple of slides, which I'm not going to go into detail, basically, I mean, if you have time, you can read through it. It's really stating out the ownership structure of the mines, as well as the details of the mines. So very briefly, we have basically acquired 5 mines altogether, combined of 226 million tons, making up of 2 entities that we have acquired, right? One of them is Batubara Development, and yeah, the other one is through PT Delhi Pratama Batubara PTDPB. Okay, the rationale for the acquisition is, of course, like I said, it's really to address the lack of supply, or the supply security that we have been facing for the last couple of years, really to bolster our second growth engine as far as the coal trading is concerned. Now, of course, what comes with it, with the owning of the mines, will be, of course, the leverage of economies of scale, and also, of course, to complement the growing shipping business and to create our shareholders' value. Okay, just to give you a pictorial appreciation of where our mines are, this is where it is. Okay, it's located sort of south east of Kalimantan. As you can see, yeah, where we are pointing, the big red circle is the entire 5 mines that we have. The yellow circle denotes the latest 5th concession that we acquired through Batubara. Now that little yellow line that leads from the mine to the river, yeah, that's that which denotes the distance of 85 kilometers. That's the road hauling, the haulage road to the jetty, and then it travels down to the Barito River. Yeah, about 335 kilometers to the main jetty where the stockpile is going to be, and from there it's either going to be exported or it's going to be transported to a customer locally. Okay. In terms of the execution going forward, as far as the mines are concerned, we are looking at a mix of between end 2024 to 2025 to start the production. And of course, all these are subject to the external factors of, weather, it could be, or the contractors and things like that. Yeah. Okay. Okay, at this stage, I think also would like to touch on a little bit of the history of RGD, which will then gives us an understanding of the execution ability that we have. The founding shareholders has been in the business of coal mining for the last 20 years and has been successfully operating a couple of mines. And it is through them that we have found all these mines for the acquisition. So they will be behind supporting us as far as the experience and the expertise is concerned. And adding to that, to mitigate the risk, we will also be engaging reputable coal mining contractors in Indonesia to do the execution and the mining for us. So with this, I think we are extremely comfortable and we feel that the execution risk is really, really being addressed. Okay. The last part of the presentation, which we have announced just recently, is that we will be looking at a share split of our existing share. I think currently our share price is doing something like $1.10. So we will be looking at splitting one existing ordinary share into 5 ordinary shares. Now, the rationale behind this is, of course, really to improve the liquidity and also, of course, to encourage trading volume and to make it more affordable. Now, along with it, in the announcement, which I'm not going to go through in detail, but you can read it, one of the major things that will be impacted is, of course, the dividend that we declare on 3.5 cents per share prior to the announcement of the share split will then be dealt with accordingly and be adjusted to the number of shares that we will be splitting. Yeah. Okay, in summary, before I end this presentation, I think really RGD has 2 complementary business units, which is the shipping and the coal. And as I have gone into detail to explain these 2 engines of growth that we have and how we're going to address it going forward. And we are really excited about what it could deliver in the future, given the expansion path that we have laid down. Yeah. So with this, I will end the presentation, given the 20 minutes that I have, and hand it back to Gerald. Thank you.
Thanks so much, Francis, for sharing your company developments and how we can think about your prospects going forward. Quite a number of different things that you touched on. So I do have some questions that have come in relating to what you have shared. But for everyone else who has joined us tonight, if you've got any question for Francis, the CEO, or Thomas, the CFO, do put in your questions in the Q&A box if you have joined us via the SIAS channel. And I'll be happy to direct these questions to the management during tonight's session. Okay, so we'll start with some of the questions that have come in prior to the webinar tonight. Maybe I start with your shipping business first. You shared earlier about some of the additions to your fleet earlier. maybe you can provide additional details as to how the additional tugboats and barges can potentially improve your overall capacity and how we can think about the shipping business going forward.
Okay, I think, okay, if I can refer to the slide number 7, where we actually depicts 7. Yeah, the nature of our shipping. Okay, I think if you go into this slide and you can see that how this explains how our shipping logistics segment earns our revenue. Yeah. Now, basically, we have two. Okay, in the shipping segment, we are broken down into either transshipment services or the chartering services. Transshipment services meaning our tug and barge actually goes from the loading port to the mother vessel, loading onto the mother vessel, and the mother vessel goes to the end destination. And our chartering services will be actually from the loading jetty all the way either island hop or to the end customer. So literally what it means is that the more vessels that we have, the more business we could do, the higher the volume is. And that's what the deadweight ton actually represents. As of now, which we have presented, we have 236,000 deadweight tons. And with the increase coming in, we hope to be able to build it up to close to 300,000 deadweight ton. And that will translate into the per unit revenue.
Do you see more opportunities in the transshipment services or the chartering services segment?
Well, at this moment, in terms of the volume split, we are on a factual basis is there will be more transshipment than it is the chartering, and we do not see any change in that trend. Yeah.
So with the additional fleet that might be coming in, effectively, we will still have a larger emphasis on the transshipment services versus the chartering services.
Yes, you can say that, yeah.
Is that
in terms
correct?
of volume, yeah. Yes.
Okay. Okay. Are there larger trends that we see around these two different subsegments that might actually affect the mix of the business over the next 3 to 5 years?
Yeah, I think the larger trend that what we are seeing at the moment is that I think Indonesia is a very strategically placed as a resource play. I think in the last 5-6 years, Indonesia has really emerged as one of the new metal player with resources like nickel, cobalt, copper, and bauxite and things like that. So with this, really, there is, like what Isaac has said, is bull in the China shop. Really, there's a tear in the commodities, and as a result, the tremendous volume of movement between the mines and the island hopping and all that. Now, that's really the overall governing trend of it. And with the industrial setting up to process these kind of metals, RGD is really very, very well placed in terms of supplying the coal to the generators. That's the trading side. And also participating in the resource movement between islands, between ports, between destination. Yeah. So that is really the macro trend that Indonesia is experiencing now. Yeah.
Given this macro trend and your current fleet, how do we think about your competitive edge in the shipping market, given that some of your other peers might be looking to be growing their fleet as well?
I think as far as the shipping is concerned, we have actually gotten in at the very right timing. When we first started looking at our fleet expansion, shipping was not doing well at all. So what does that mean? That means we have been able to acquire new fleets at a lower capital cost. and is able to ride the trend right now and generating healthy cash flow for us, which we reinvest to expand to expand our fleet. So what does that mean is that all of our tug and barge are new builds. We do not rely on second-hand, and as a result, our tug and barge has always in a much better condition, able to charter at a higher rate than most of our competitors.
Okay, we'll move on to talk a bit more about the trading business. You mentioned earlier that one of the challenges faced in the previous year was the lack of coal that you could effectively be trading in. Apart from what you have shared in terms of the acquisition, then providing the coal that might be needed, are there other initiatives that have been taken to be able to improve the performance of the trading business?
Okay. Well, I think what happened is that prior to this corporate action of acquiring the mines, we were really depending on some of the related party mines that we are supposed to source from. Now, what happened is that I think there were many factors affecting the mine production, and one of the major one was that the mines that we have been sourcing from has come to or near to the end life of the mine, and as a result, production level has come down. So over the years, we have not been able to be given the allocation that we have planned to. So in the working of this couple of years, we were able to finally this year get our hands into acquiring the mines. Now, as a miner, when you own your own mine and you're able to produce, you have your in-house cargo, so to speak. And the competitive edge and the improvement will come from the fact that you are at the, a upstream supply chain that you are able to capitalize and acquire that additional value that comes in that. As opposed to just trading. So we can see that our margin on that part of it is going to improve going forward.
Okay, maybe we can discuss a bit more about this acquisition since it helps to shape a few of your different businesses. In terms of the coal production that you have, how would that actually change the total volume? And what kind of uplift are we looking at potentially for your trading business?
I think at this stage, we are still looking at about 8 months to a year from the actual production itself. So we would not be able to share very much of what a forward statement is. But all I can say is that even before these mines, at the peak of our trading volume, we are doing something like 1.3 to 1.5 million tons a year as a trader. And now that we are getting ourselves into owning the mine and mining itself, it's not difficult to actually imagine that our volume for our trading side will grow leaps and bounds with the mine supporting us here.
Okay, if I may just jump back to your shipping business, I have this question from a participant here, wanting to understand a bit more about your competitors. This participant probably quite familiar with the Singapore market because he or she has listed a few companies like ASL Marine, Marco Polo Marine, Samudera. Are they considered your competitors?
Yes and no. Yes and no. I think as far as shipping is concerned, when you say competition, normally we segmentize, right? So you have basically the bulkers, the tankers, and then if you go down the line, you will have Panamaxes, and then you have Supramaxes and all that. So to really compete and within the exact space of what we have is really tugs and barges. So we are not exactly in the perfect competitive space of ASL Marine or Marco Polo per se, in that sense, because they serve other sectors as well. As far as we are concerned, ours is in the tug and barge. And like I said previously, when we mentioned about why are we so competitive, and where is our competitive edge, and that's really where it is. Yeah, we operate in the tug and barge, in the transshipment services, as well as the movement of the resources around the island. Yeah.
Okay, I think one of the things you have shared are your expansion plans around the acquisition. You also have a growth in your fleet over the past few years. Can you maybe share how you intend to actually fund some of these expansion activities?
Yeah, okay, that's an interesting question. I think all these years, in the last, or at least since our IPO day of 2020, we have been growing organically using internally generated funds and resources. Our two segments have been able to generate very healthy cash flows for us to do the reinvestment and expand. Until this year, when we start to acquire mines, which we will be coming out to do a placement. We have actually announced, if you go into the SGX nets or to our website, you will be able to see the number of announcements that we have made, and one of which is that our intention to come out to do a placement of 10 million shares to the market. And this fund that we raise will be solely used for the purpose of this expansion.
Okay, thanks for that explanation. Relating to this is on your dividends. I think what some might have observed is that you actually increase your dividends in the previous fiscal year. So how do we think about being able to fund your expansion plans while at the same time paying out an attractive dividends to shareholders?
Okay, Gerald, I must say that looking at the chart of our dividend history, I think we have a page on that. If I can show that on page, yeah. I think this is what you are referring to as the payout ratio increasing. Now, I must qualify that we do not have, at this moment anyway, a fixed dividend policy. So what it is that all I can comment is that, of course, we will do our best to continue with our dividend payout. But one has to be mindful that I think we are a young company and we are engaging on a quite an aggressive expansion path. And generally for companies on such path, we need to conserve quite a fair bit of our cash for the purpose of the growth. And as a result, we would not, that's the reason why we at this moment do not want to have a fixed dividend policy like the mature companies where growth are relatively smaller and is able to predict and have a fixed cash flow coming in. Yeah.
Okay, thanks so much for sharing about your thinking around the dividends. Next, we have a question from Jennifer, who is one of our live participants tonight, very concerned about ESG related issues. So her question is, do we see coal being phased out due to environmental issues? And I guess a related question to that is then how is your company reacting to some of these changes?
I think being in this space, obviously we are continuously and being bombarded with this ESG issue, and rightfully it should be, right. The question of the validity of coal is really a question of the time horizon that we are talking about. Now, if you were to ask me, will eventually coal be phased out? Very possible that it will be, but what kind of time frame are we talking about? Is it going to be 30 years from now, 50 years from now? I think what happened is that the world has today changed their stance as far as fossil fuel is concerned. I think the world started off with a very aggressive stance of wanting to phase out the fossil fuel or what we call the dirty energy quite a number of years ago. And they realized that the ability to do so is really not realistic. So what happened is that I think in the recent years, the world has adopted a stand of a more amicable stand of energy transition. In other words, allowing countries that are right at the bottom of the rank to be able to have a timeline to be able to transit to a more renewable and ESG compliant type of energy. So the same that we see in this part of the world, with China and India growing and with Southeast Asia growing as well. I think coal is here to stay for the foreseeable years that we can tell or within our lifetime. And as far as the ESG is concerned, we are of course cooperating with and complying with all the requirements that is dictated by the government, by the bodies, by the established institution that's watching over the fossil fuel. There's no doubt about that. With the sustainability reports and all that we have to be doing. And as a listed company, we definitely will comply with all the requirements that is stated out there. Yeah.
Okay, another question from Jennifer. In terms of your geographical exposure, are all your customers from Indonesia?
Okay, as far as the trading is concerned, as you know, Indonesia has a domestic market obligation. So a certain percentage of the volume needs to go to Indonesia. And beyond that, once you satisfy the DMO, we are free to export to anywhere. And we have done so exporting our cargo to China in the past year.
Okay, I think we have about just enough time for some closing questions and remarks. I think just one final question from Jennifer. For your trading of coal, does it involve any forward contracts or is it just plain vanilla buying and selling?
No, we do not get ourselves involved in any highly speculative behavior. So ruling out any of the futures that we do. Not only just plain vanilla, I think we have been very conservative. We are literally doing almost back-to-back trading here.
Okay, I think that's very good and helpful to know. Do you have any final remarks or comments for our participants tonight?
Well, my final remark is, of course, the purpose of coming onto this platform is really to introduce RGD. So I really encourage the participants to take a look at our website, understand us. I think in particular, look at the corporate actions that we have announced. That will give you a good view of where we are and where our growth path is. Yeah. And thank you very much for your participation, of course. Yeah.
Thanks so much, Francis and Thomas, for your sharing tonight. And for all the participants, we hope you found the Corporate Connect session informative. Like what Francis shared earlier, if you would like to understand more about the company, do look up the company's announcements, annual reports. And if you have any questions, do feel free to contact the investor relations of the company. If you missed any part of tonight's session and want to rewatch, you can actually do so via SIAS Facebook page or via SIAS YouTube channel. In case you want to understand more about Corporate Connect, this is a monthly webinar that is hosted by SIAS to be able to allow you to get better understanding of various companies that are listed on the Singapore Exchange. The next Corporate Connect webinar will be with LMS compliance, and that is on 23rd of April. If you'd like to get updates on some of these upcoming investor education programs, you can visit SIAS website as well. So thanks so much for joining tonight's session. I hope you have a very good evening and look forward to seeing you the next time. Thank you.
Thank you. Thank you very much.